I'm Megan Horniman, the Chief Investment Officer for Verdence Capital Advisors. We're coming to you today to give you a review of the first 3 months that we've seen of 2022 and then what we see it transforming for the remainder of this year. Now, coming into 2022, we knew that the economic environment would be a bit more challenging. We were looking at inflation running at levels we haven't seen in 40 years. We were talking about the pent-up demand starting to fade from the quarters we saw after the pandemic. And we were talking about the lack of fiscal stimulus that wasn't as beneficial to economic growth. Now, there's a couple of events that occurred that really took the markets by surprise. First of all, the Federal Reserve did a complete about-face with interest rate policy, coming into the year talking about inflation being transitory and now having to pivot to a much more aggressive tightening policy. Then we had the devastating Russian invasion into Ukraine. Those two things were really a recipe for very high volatility and disappointing returns for investors in the first quarter. Specifically, if you were invested in primarily just a 60% equity portfolio and 40% bonds. That combination was negative in the first quarter. And when you go back over the past 30 years, this was a very different situation than investors have been accustomed to. Over the past 30 years, that has only occurred less than 5% of the quarters during that time period. Now let's delve into what happened from an investment perspective in the first quarter. And as you can see in this chart, U.S. equities across the board were negative. The one area of the U.S. equity market that was challenged the most was the large cap, those growth areas of the market. And that's because these areas tend to have higher multiples. They're more expensive. And when you're talking about pulling away easy monetary policy, they're the areas of the market that are going to sacrifice the most. When you look internationally, you saw broad-based declines in international markets, primarily because of the uncertainty of what the war between Russia and Ukraine would mean for growth prospects. When you look at the fixed income market, you can see that primarily fixed income was negative. That's because the Federal Reserve basically turned a switch overnight and insinuated that they would have to be much more aggressive this year in tightening monetary policy. That's a negative for fixed income, specifically long duration fixed income. But when you look at commodities, that was really the only place to hide in the market. Commodities benefited from basically the supply and demand imbalance that we've seen for some time, but also because of the disruptions that were going on because of the war between Russia and Ukraine. Now, because of such a disappointing quarter for investors in the first quarter, there's a lot of questions going forward, a lot of uncertainty, and we understand that. We're here today to try and clear up some of these questions from an economic standpoint as well as from an investment standpoint.